Did you know that one of the most popular EV stocks on the entire market just landed a massive upgrade and a fresh $7 price target from Goldman Sachs? Yet the stock is quietly bleeding out on less than half of its normal trading volume. That right there is the central mystery of today's video. Welcome back to Calvan Mateo, the channel where we cut straight through the market noise and get to the truth that Wall Street would rather you didn't notice. In the next few minutes, I'm going to break down exactly why the market appears to be betting against NIO, even as this company is smashing record delivery numbers. We'll unpack the strange volume collapse, the hidden margin trap buried inside their growth story, the fiercely divided analyst battle, and the exact price levels that could either send this stock soaring or send it crashing straight through the floor. By the end, you'll understand this setup better than 90% of the people currently trading it. If you find this kind of deep dive analysis valuable, do me a quick favor and hit that like button and subscribe. It genuinely helps the channel grow and it keeps this research free for everyone. Now, let's get into it. Right now, NIO is caught in a fascinating state of total market paralysis. After peaking near $5.21 in mid-July, the price has simply drifted lower, settling flat around $4.79. But here is what should truly stop you in your tracks. It's the volume. Normally, this stock trades around 39 million shares in a single day. So what happened over the last few sessions? It quietly collapsed to just 17 million. Now think about what that actually means. This isn't an aggressive, panic-driven, everyone run for the exits environment. No, this is something far more unsettling. This is an environment where the buyers have completely and utterly stepped aside. And here's the golden rule that separates the pros from the amateurs. When a stock cannot rally on historically great news, the tape itself is flashing a major warning sign. The silence is the story. But that's only half the story, because on the surface, NIO's operational growth looks absolutely unstoppable. Just look at the raw numbers. They just hit a massive milestone, delivering over 107,000 vehicles in the second quarter alone. They launched their brand new Firefly Habitat Compact EV at a premium price point of 133,300 yuan. And perhaps most impressively of all, they delivered 300,000 of their own in-house assisted driving chips. Let that sink in. They're building the brains of their cars themselves. On top of that, they're aggressively hedging against soaring supply chain costs, quietly funneling $23,300,000 into China's largest DRAM maker just to offset the brutal 20,000 yuan memory chip cost sitting inside every single ES8. So they are scaling horizontally and vertically at the exact same time. It sounds incredible, right? It sounds like a runaway winner. But while these growth numbers look absolutely spectacular on a slide, there is one hidden metric we're about to look at that quietly changes the entire equation. And if we dig just a little bit deeper into the actual numbers, something troubling starts to emerge. What we find is a severe strategic dilemma, a genuine tug of war between market share expansion on one side and margin compression on the other. Here's the setup. NIO's sub-brands, Onvo and Firefly, have absolutely surged, now accounting for a massive 43.4% of second quarter deliveries. But it gets even more dramatic than that. These lower-priced vehicles accounted for a staggering 90% of their entire quarter-over-quarter delivery growth. Now, here is why that should matter to you as an investor. NIO's premium-tier vehicles are the true anchor of their profitability, boasting a healthy 18.8% vehicle margin. But as this delivery mix violently shifts away from those premium cars and toward the mass market, lower margin models, it threatens to trigger a brutal wave of corporate margin compression. So the question that almost nobody is actually asking is this: is NIO pulling off a brilliant calculated market share grab that will pay off enormously down the line? Or are they simply running faster and faster just to stay in the exact same financial place? Could it be that all this dazzling growth is secretly making the company less profitable, not more? Which leads us straight to the ultimate bull case and the exact reason Wall Street is so fiercely divided right now that analysts are practically at war with each other. Goldman Sachs recently upgraded NIO all the way to a firm buy, and they did it based on an incredibly aggressive, almost breathtaking financial model. They are projecting a monumental 15.2 billion when positive swing in free cash flow. In plain English, they believe NIO can go from a 12.4 billion loss all the way to a 1.6 billion profit. That, right there, is the entire bull case in a nutshell. A dramatic, near miraculous turnaround. But here's where it gets spicy, because the institutional consensus is anything but united. While Goldman sees a premium high-flying turnaround, Weiss Ratings is standing firm with a hard, cold, unapologetic sell. And caught right in the middle, the broader street consensus is stuck at a cautious, non-committal hold. And believe me, there's a very good reason for all that skepticism. To actually hit Goldman's ambitious profit target, NIO needs to average more than 45,850 deliveries every single month for the entire second half of the year. Now consider this: June came in at just over 40,000. So that target isn't just a stretch, it's a monumental leap. Which begs the question, what if they miss? What happens to that beautiful Goldman forecast if the deliveries simply don't show up? Now, none of this optimism matters at all if we don't take a hard, honest look at the risks lurking underneath. The bear case focuses heavily on two brutal realities: persistent unprofitability and fierce European headwinds. Because despite all those glittering delivery records, this company reported a GAAP operating loss of over 308 million RMB in the first quarter alone. And it doesn't stop there. Their ambitious expansion into Europe is slamming face first into a brick wall of stiff tariffs and shockingly weak demand. That painful combination is directly forcing recent price cuts in key markets like Norway and Portugal. And when you start cutting prices to move inventory, brand dilution stops being a theory and becomes a very real, very immediate threat. So with this intense, high-stakes tug-of-war raging between the bulls and the bears, you might be thinking that eager retail investors could simply pile in and trigger a massive short squeeze that sends the whole thing to the moon, right? It's the dream scenario every trader fantasizes about. But before we get anywhere near that short squeeze fantasy, we have to expose the hidden mechanics that are quietly trapping this stock right now. Take a close look at the options data, because this is where the real story is hiding in plain sight. Market makers have effectively trapped this stock inside a suffocating 50-cent corridor. Up above, there's a heavy call wall sitting at the $5 strike, with over 10,000 contracts of open interest, acting like an iron ceiling that the price simply cannot punch through. And down below, there's a massive put wall at $4.50, with nearly 16,000 contracts acting as a stubborn concrete floor. The dealers are enormously incentivized to keep the price pinned right in the middle all the way through Friday's expiration so they can collect that juicy premium. And as for that dream of a short squeeze, I hate to break it to you, but it is statistically improbable. Total short interest sits at only 130 million shares, which is just 5.3% of the float. That's far, far too low to trigger any kind of systemic squeeze. And it gets worse for the squeeze crowd because the shorts have actually been covering, with interest dropping 2.9% recently. We even spotted a bearish whale stepping in, selling a sweep of 310 call contracts at the November $4 strike. In other words, the smart money is positioning for weakness, not a rocket ship. So if a squeeze won't do it, what on earth could actually break this stock out of its prison? The honest answer is that we need a genuine macro shock to shatter this eerie, low volume equilibrium. And the single biggest immediate catalyst on the radar is Tesla's second quarter earnings report. The options market is currently pricing in a massive 7% swing for Tesla. And here's the thing about this entire sector. Wherever Tesla goes, EV sympathy momentum tends to follow right behind it. That one report alone could be powerful enough to completely overpower NIO's option dealers and blow the price right out of its cage. On top of that, you've got a genuine wildcard in play, competitor scandals brewing in China, with rivals like Li Auto facing intense public backlash. And that kind of controversy could quietly funnel curious buyers straight into NIO's showrooms. Now, technically speaking, keep your eyes glued to two critical levels. If the stock closes below that $4.50 put wall and breaks the $4.39 pivot, the entire bullish thesis is instantly and completely invalidated, and the chart breaks down in ugly fashion. But flip it around. A high-volume push above the 50-day moving average at $5.22 would force the dealers to unhedge their positions, and that mechanical unwinding could squeeze the price sharply higher. So which way does it break? Could a single Tesla report really be the domino that topples this entire standoff? And that brings us to the final verdict and the three distinct scenarios you absolutely must be watching for. Heading into expiration, there are essentially three probable paths this stock can take. The bullish scenario requires Tesla to post blowout, jaw-dropping earnings, lifting the entire sector on a wave of optimism and pushing NIO up to challenge that $5 call wall. The bearish scenario is the mirror image. The broader market dumps tech in a wave of fear, dragging NIO right down through its $4.50 support and triggering a cascade of mass stop losses. But here's the twist that most people won't want to hear. The base case, the single highest probability scenario, is actually the most boring one imaginable. Volume stays dead, and the stock chops around aimlessly between $4.70 and $4.95, going absolutely nowhere while frustrating both bulls and bears alike. Before I give you my final thoughts, I need to share an important disclaimer. Everything discussed in this video is for educational and informational purposes only, and it is absolutely not financial advice. I am not a licensed financial advisor, and nothing here should be taken as a recommendation to buy or sell any security. Investing in stocks, especially volatile ones like this, carries real risk, and you can lose money. Always do your own thorough research and consider speaking with a qualified financial professional before making any investment decisions. Your money is your responsibility. With that said, here's the bottom line. The final verdict is simple. Trying to catch this falling knife right now carries outsized structural risk. Do not, under any circumstances, rely on 15,000 options contracts to act as some kind of ironclad floor when major macro shocks are looming right on the horizon. Entering here at $4.79 is fraught with hidden danger, my honest take. Wait for the macro dust to settle, respect your stop losses religiously, and let the market fully show its hand before you commit a single dollar of your hard-earned capital. Patience here isn't weakness, it's a strategy. So now, I want to hear from you. If you were forced to place a bet today, Do you think Tesla's earnings will finally break NIO out of this 50-cent prison to the upside, or do you believe the low-volume trap keeps this stock stuck in limbo? Drop your prediction in the comments below. I read every single one, and the discussions down there are honestly some of the best on the platform. And if this breakdown helped you see NIO in a completely new light, smash that like button, hit subscribe, and turn on the notification bell so you never miss the next deep dive. This has been Calvan Mateo, helping you trade smarter, not harder. I'll see you in the next one.